Corporate finance practice problem using Excel. Zero coupon rate bond price calculations. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information on the left-hand side, we're going to populate that information into the blue area on the right-hand side, calculating the bond price again. However, this time, new thing, we have this zero coupon rate bond. Note that in normal bond calculation prices, we had a whole section in on that in a prior section, so you might want to go back there if you want to look at the normal bond calculation prices a little bit more slowly and with multiple different methods and scenarios. We're focusing here on the new item, which is basically the zero coupon rate bond in this case. Also note that if you are practicing present value calculations, book problems often using bonds to do so, you might want to go to our section on present value calculations, which we do the present value calculations with not just Excel formulas, but also tables and formulas and so on. So here we have the face amount of the bond. It's going to be 1,000. It's a zero coupon rate bond, which basically should make the calculation easier because now we don't have the rate that's being calculated. It's issued to yield 10%. So in other words, you can kind of think about that as like the market rate. And then the years to maturity, we're going to say are 15 years. Now, normally when you calculate the price of the bond, we have the annuity component, which is the interest component, but we don't have it this time. So normally you have to take the present value of an annuity calculation for the interest, but that's just simply going to be zero. So really all we need is the present value calculation of the principal, or the 1,000 in this case, the amount at the end of the term of the bond, which would be 15 years discounted at the 10%. So that's going to be our calculation here. It's going to be negative present value, shift 9. The rate is going to be that 10%, comma, number of periods is going to be the 15, comma, and then the payments is, we don't have any because this is not a no interest. We're saying comma, comma then. Future value being that 1,000, which we're just bringing that on back to the present time. That's going to be the 239, adding a couple decimals here. There we have it. That's going to be the price of bonds, and we're going to sum that up. Obviously, 0 plus the 239.39 is going to be the 239.39. So it should be a more straightforward calculation. It can be a little bit confusing when you see that, though, because you're not used to seeing a bond typically without the coupon rate. And so that could throw you off when you first kind of look at that. But let's just do it again. Let's imagine now the rate is 7%. So face amount is the 1,000. There's no coupon rate. We're talking basically the market rate issued to yield the 7%, and then the years to maturity are 15. So same kind of thing. We're going to say, well, that means that the present value of the interest is 0 because we don't have a rate on the bond. It's no coupon rate bond. The principal then would then be calculated as negative present value, shift 9. Rate is going to be then the 7% this time, comma. The number of periods we're going to say is 15, comma, comma, because it's not an annuity, but present value of 1, and picking up the 1,000. There we have it. Let's add a couple decimals, numbers, couple decimals, and then the price, summing that up, equals the SUM, shift 9. And then we'll add some decimals there. Number group, couple decimals. Let's put some underlines in place here. Font group, underline, font group, and underline. So here we have the 362.45. Notice as the market rate basically goes down here, you see the price going up. So it's inverse to the market rate. Let's do it one more time where the rate is higher than the 10% where we started at. So the price, the present value of interest is 0 because it's no coupon bond. And then we've got the present value of the principal, negative PV, shift 9. Rate is now 14%, comma. Number of periods is now 15, comma, comma, because it's not an annuity, but present value of 1. Then we pick up the future value of that 1,000. Add a couple decimals, number group, adding decimals, then underlining, font group, and underline. That will then give us the price of the bond. Summing that up, and there we have it. We got the 140 number group, adding a couple decimals. So obviously at the 10%, we got the price or value at the 239.39. If the rate went down to the 7%, then the inverse relationship means the bond price went up to the 362, and then when the rate goes to 14, then we have the bond price going down, inverse relationship 140 and 10 cents.